Hey everyone, welcome back to the channel. This is Ben Morales, your personal financial coach. And in today's video, I'm going to be answering a question that was made on one of the previous videos that I made. This is a gentleman by the name of Jay, and Jay says, "Hey Ben, is there any alternative ways to home ownership?" It looks like he currently lives in a parsonage with his wife, and they're looking to put down roots and start a family. And so they're looking to pay anywhere between 50 to 70% down as a down payment to buy their home. And they want to get a 10-year loan. So, in this channel, we don't encourage loans. We actually encourage home equity lines of credit. But let's look at it. Maybe that is a good move for this particular family. We're going to discuss that scenario. And his question is there any way to avoid the ridiculous upfront cost, or should we just minimize the principal? So let's do a scenario for Jay and his wife into what that might look like when they're going to go and buy that home. So let's say the home is going to be valued at $200,000 and they decide they're going to put 50% down. So if we put 50% down, we know that that's going to be 100 grand basically for them to get into this particular loan product. Now, what is not really viewed is that 100 grand is actually coming at a cost to them, because once you make that $100,000 payment to the bank as a down payment, you never have access to that money again unless you go and refinance and pull it out once again. So the 10-year term, what does that look like in terms of a interest rate? Well, right now, as I did research on it, found interest rates right around 6% for a 10-year term. Meaning what? Well, a principal and interest payment for a 10-year loan with a 6% interest at $100,000 is $1,110.21. Okay, so the nice thing about that particular loan is, yes, by this time, because of the large down payment, most of the payment is going toward the principal. $610 worth is going to the principal. $500 is going to the interest. But now here's where the cost really comes in, because the actual interest cost over the 10-year period is $33,224.60. That's the actual cost. To get that interest savings, it actually costs us $100,000 to do so. So the problem with that is, once you give that money again to the bank, you never see it again. And if there's an emergency, or there's repairs that have to be made, or for whatever reason, a car breaks down, the boiler goes bad, the roof goes bad, something goes wrong with the home, and they don't have sufficient money saved up, they're going to have to go back to the bank and ask for that $100,000 or a portion of it that they gave when they paid the home. So let's talk about the disadvantages of loans and why we really discourage that as being used as something to buy the home. So loans are close-ended. What did that mean? That means that anytime money that you send to a loan mortgage or mortgage loan, you lose the ability to reuse those funds again. So if you need them for an emergency, if you need them for repairs, if you need them for anything outside of the scope of the actual paying down the home loan, you need to then go back and get approved again to get access to the funds that you gave the bank when you actually bought the home. So yes, they do come with lower interest rates, but again, over time, it actually comes out more expensive. And then it doesn't matter if you make $100 or $200 or $300 extra payment to that particular loan. The following month, you're going to have the exact same monthly payment. And this is why I encourage my clients to use lines of credit. Lines of credit are open-ended, okay, which means that they're revolving. It's just like a big credit card. You have access to the money once again, right? If you have emergencies, you have access to those funds. As it is paid down, that same money that you're paying down is going to be accessible for you to use in any case that you might need it for. So even though it has a higher interest rate over time, the lower cost is what really, really is important. The cost, especially if you are implementing either an accelerated banking or velocity banking strategy to help offset some of those costs over time. And then the nice thing about the line of credit, as you are paying the line of credit down, you're going to get a lower monthly minimum required payment as well. So as I was looking, making research for this particular scenario, I found some rates that are available already on the internet. And these are just simple rates that are available from, for example, Bank of America. And you can see here, these are all rates that are very not too far off from the 6% 10-year loan rate that he would acquire by utilizing a mortgage. So you have a Bank of America offering 6.49. That's a 6 months introductory period, and then it goes up a little bit afterward. US Bank is offering an 8.7. You have Sophie, which is an online bank, and they're offering actually rates as low as 6.99%, 85% LTV, which is awesome. And then I also included a credit union there, so you can see that sometimes you may not be able to get a rate with the bank, but you can actually check out some credit unions and see what they have to offer as well. But BCU has a credit line right now, or a home equity line of credit for 7.75. And the nice thing about that, they also have a 2.99 for 3 months introductory period. So let's look at what that would transfer into a particular purchase for this family as an alternative method into home ownership. So if we utilize a first position home equity line of credit, even with an interest rate of 7.75, it's going to more rapidly and efficiently help them eliminate interest costs over time. Now, because we are putting such a large portion down as a down payment, again, if you did it on a mortgage loan, that money would be gone. But if you use a first position HELOC, what happens? Well, the first position HELOC will give you the ability to access immediately equity of that home. So if the home is worth 200,000 and you're putting 100,000, that means you have equity already available because you made such a large down payment. The banks would allow you to borrow, in many cases, up to 90% of the value of the home. What does that transfer to? Meaning 200,000 is the value, 180,000 is actually 90% of that value, meaning that the home equity line of credit that is used to purchase the home has a limit of 180,000. That means that although they put $100,000 down, if their balance is going to be $100,000, they still have $80,000 extra to work with to cover for emergencies or repairs or something were to happen. So immediately, a greater portion of that $100,000 has already become usable because they didn't make it as a down payment when they got a mortgage loan. So I hope that makes sense because that makes a huge, huge difference. Now, they go into the loan, they owe $100,000. Well, that's the balance of their home or the loan going into it, the balance of the line of credit. Now, this family, not too far to believe that they have at least $1,000 in cash flow, right? They've been good saving, and now they should have at least $1,000 in cash flows to be able to implement this strategy. When they do that, what do we do here? Well, we take the cash flow that they have at the end of the month. We also are going to take the principal and interest payment that they would have made to a mortgage, and we're going to give that back to them. So that means that they're going to have a new cash flow of $2,110.21 because they no longer have a mortgage payment. If their cash flow was $1,000 after making their all their expenses, that means we add back the mortgage payment that they would have paid, and we're going to be able to leverage that right back into the home equity line of credit and run all the monthly expenses through that home equity line of credit. When we do that, we start off with a balance of $100,000. We know that 2,110 and 21 is the new cash flow. So how long does it take to pay off that $100,000 with an interest rate on a 7.75 on a first position HELOC? Well, the answer is 4.9 years. That's how long it takes. It doesn't take 10 years, right? It takes 4.9 years, so almost half of the time, a little bit less than half of the 10 years to actually completely pay off the $100,000 in a home equity line of credit. Now, what does that look like in terms of overall cost of interest? Well, the interest cost for these 4.9 years was $19,764.13. So look at the huge difference, even with a higher interest rate, right? Because why? Home equity lines of credit, the way their credit is calculated or the way their interest is calculated is on an average daily balance. Not so with a mortgage, right? Mortgages are amortized. So the difference is huge. We have $33,000 to $24,60, and then we have $19,000. So we're looking at almost $14,000 savings, additional savings throughout the course of the 4.9 years that it took them to pay off this particular $100,000 in a home equity line of credit. So there you have it, folks. So Jay, I hope this makes sense to you and your family. This is one of a secondary alternative way that I'm going to be showing in a different video how to pay off a home or get into home ownership a little bit differently than what the standard products that the banks are offering. So again, I hope it makes a lot of sense. Continue to like, subscribe, and share. And I want to thank you for supporting the channel. It helps the channel grow. So continue to make comments. I look forward to making that next video for you just very soon. Thank you for tuning in.